I've worked with literally thousands of traders over the last few years, and there's a lot of commonalities between the traders that are profitable and that aren't profitable. And I'm gonna let you guys know the 3 main reasons as to why traders remain unprofitable, so it'll help you guys out in your current situation. Because one thing that even Warren Buffett says is, yeah, sure, you could actually make something of yourself by learning from your own mistakes, but you'll exceed further in life when you actually learn from other people's mistakes. So the first and number one thing that I've always noticed when I hop on a call with a specific trader or we're going over a group webinar, they're asking me questions, the very first thing that unprofitable traders have in common is they really just don't have an edge. They keep strategy hopping, or they have 10 different strategies that they try and execute on a daily basis. And that's actually one of the things that I almost found myself doing this year. In the beginning of the year, my playbook had a consistent list of 5 different plays that I would look to take every single day. That would be in between breakout setups, reversal setups, bounce play setups, or continuation setups. And what I did over the last, I would say probably 2 months, was I removed almost every single strategy out of my playbook and focused on just the 2 strategies that made me the majority of my money this year, which are going to be reversal setups, and they're also going to be low volume node continuation setups. So number one is you have to identify what your edge is. Doesn't matter what market you're trading, if you don't have an edge that you could back test and prove that those results have a positive expectancy, meaning that over a long period of time they're going to make money or at least beat the S&P 500, then it really doesn't matter what you do on a day-to-day basis. You could journal, you could execute trades, you're just not going to be profitable over a long period of time. And this is kind of like, I guess, like a multi-topic part, because a lot of traders have like that beginner luck when really the market's going to go either up or down and they can make money regardless. But you need an edge to be able to make money over a long period of time. And most of you guys probably can't even answer off the top of your head what your trading strategy is right now. That's just the number one common trade that I've seen with mainly newer traders. Now, once we get into traders that are a little bit more experienced and advanced inside of the markets, the ball kind of changes a little bit here, because at that point, like, you have a strategy in place, you know what you're looking out for on a day-to-day basis, but you don't have a trading plan. Now, most traders, when they don't have a trading plan, they're trading at awkward times of the day, whether it's Asian session, London session. They're just trading outside of volatility windows when their instrument typically moves, just simply because they don't have like a consistent approach to the markets. And if you don't have a consistent approach to the markets, it's kind of like, how are you actually going to be a consistently profitable trader and make money over a long period of time if your approach to the markets isn't even consistent to begin with? One day you're trading New York, one day you're trading Asian, one day you're trading London session, one day you're trading the New York-London crossover. Like, there's just so many different variables that it's going to be very difficult for your edge to play out and be profitable over a long period of time if you don't have a basic trading plan. Now, I've made hundreds, or I don't want to say hundreds, but I've made tons of videos on trading plans to begin with. But just to give you guys a rough draft and a breakdown as to what your trading plan should include, should be number one, the instruments you're going to be trading. Number two, your pre-market analysis time. And in your pre-market analysis time, really all you're going to list off here is your pre-market game plan for the day, what levels you're going to be looking out for, and potential plays based off of your playbook you're going to be executing at those levels, determined based off of market structure and whatever other indicators you may use. And then on top of that, you also want to check out for economic data on your pre-market plan, other than your instruments being set. So for me, I only trade ES, so my main instrument is just going to be ES or SPX. And I know a lot of people probably trade ES, NQ, and then maybe like YM, so then you would add those into your instruments. And to me, I know the volatility windows for the futures market, or for at least the S&P 500, is going to be the New York Stock Exchange Open. So I plan my pre-market analysis before the New York Stock Exchange Open, so that way my active trading time is going to be in between the New York Stock Exchange Open and then lunchtime, where volatility dies down. So that 3-hour window from like 9:30 to about 12:30 is going to be my active trading times. And then after that, I'll have a post-market review at almost kind of like 2 p.m., a little bit after the trading session has ended, where again, I'll recap my day, things I did well, things I could improve on, the trades that I took. And that kind of leads into the journaling section, but that's just like a rough guideline of what your pre-market analysis and your pre-market game plan should look like. And then on top of that, what your trading plan should look like. Most unprofitable traders that I've spoken to over the last few years don't have a trading plan, and they also don't have a verified edge. Those are two major key factors. But I want to say what the major key factor here is in between the commonalities of what unprofitable traders specifically don't have is going to be journaling. Now, I guarantee you that over 80% of you guys watching this video, if I were to ask for your trading journal and you were to pull up what your trading journal is, it's probably going to be empty. That is completely what's keeping you unprofitable, because if your trading journal doesn't have critical information about your edge, about your system, why you're executing these trades, then you can't improve on your specific systems. You can't improve on your edge overall because you have no idea why you're taking these trades. Like, I should be able to tell you, all right, you're watching this video right now, I want you to go back to 2 months ago exactly on a Tuesday and tell me what trade you took, why you took that trade, what was the outcome of the trade, what was the R multiple in the trade, what was the planned R multiple versus the realized R multiple. And I guarantee you that 80% of you guys watching this video cannot do that. So if you're doing something, I don't want to call journaling like as simple as possible, but if you're missing out on something so critical such as journaling, where you're keeping track of your statistics, where you're keeping tracks of all of the trades that you're taking, then how do you expect to make money over a long period of time? And the probability for you to do so is going to be very slim. And I know a lot of you guys are probably like in that break-even phase, or maybe just slightly unprofitable phase where, yeah, sure, you've gotten funded but never gotten paid out. This is going to be that one critical step that's going to allow you to actually move forward into making money. Why? Because once you actually have a journal, you can see where your A+ setups are, where your A setups are, and what setups that you shouldn't be taking anymore. And that's kind of why I decided to eliminate 3 of my trading setups from my playbook overall and focus on just the 2 setups that are making me money. And then on top of that, when you go in your journal, you should be able to dissect your playbook and the specific trade setup enough to the point where you're able to determine if this is a C setup, a B setup, an A setup, or an A+ setup. So I'll give you guys a perfect example. So one of my setups that I have, my favorite setup that I have, is going to be an absorption reversal setup. Now within that absorption reversal setup, I have roughly around 6 different criterias for me to enter that market. If only 3 of my criterias are actually met, then that setup doesn't even qualify for me to take a trade, because I need to see at least 4 or 5 of my criterias to be met for me to be able to take that position. And if I only get 4, I'm entering it with light risk, or I may scrap it at all. If I get 5, I know it's an A setup. Then if I get all 6 of my criteria met, I know it's an A+ setup, and I need to add size onto this trade. So to give you guys the example, right, number 1 is we need to be trading at an area of interest. That's the main rule. Whether it be a high volume node, a low volume node inside of the markets, we need to be trading at an area of interest. Whether it be a technical key level, a supply and demand level, it doesn't matter. If we're not trading at an area of interest of mine, then I'm not going to be looking to take the trade. Number 2, I'm going to give you the example as if I'm going to be going long. I need to see strong, aggressive selling pushing into that area of interest. And then number 3 is, as price is getting into that area of interest, I need to see a large trader get filled. And what I mean by that is I need to see a large bid in this situation get filled inside of the markets for me to classify that absorption reversal setup and identify that initial absorption. Number 4, after that large trader gets filled, I need to see bids reload on the order book, supporting the thesis that the buyers are going to want to hold this market at this price, and we should see aggressive buying come in once that aggressive selling gets exhausted, and we should see a continuation and a reversal back up. And then number 5, I need to see multiple attempts. Those are going to be my 5 criteria for me to enter that absorption reversal setup. And I just told you that off the top of my head without even looking at my trading plan or without even looking at my playbook, because this is a setup that I execute on a daily basis. That is an A+ setup. And then number 6, that is an A setup. And then number 6, what makes it an A+ setup is if we see a sweep of the original absorption point, we see trap selling beneath the absorption point, aggressive buying come back into the market to then reclaim that original absorption point at my area of interest, then that would classify to be an A+ setup, because not only do we have absorption at my area of interest, we had sellers slightly get rewarded, get trapped, use as entry liquidity for bigger participants, and then price pushes back up. And especially if I continuously see bids reloading on the order book from that point, that's what classifies as an A setup versus an A plus setup. And I guarantee that at least half of you guys watching this video aren't able to dissect your trading strategy that way. I was able to dissect my trading strategy right now live in front of you guys, letting you know the differences between how I classify my A setups and my A plus setups. And now I don't blame you. Maybe you just haven't had the right mentor, you just haven't had the right guidance, you haven't been looking at the right YouTube videos, whatever the case might be is, but I'm here letting you guys know that now you need to make that change right away if you want to take trading serious and you want to treat trading as a business, more importantly. So these are the different steps that you need to take. And then on top of that, like, you should be able to go into your journal as well and go back and look at the last 40, 50 trades that you took. And one thing that I personally like to do, especially with how I'm going to determine if I'm going to let my winners try and run past my targets, is I'll set my take profit. Let's say my average take profit is set at a 5R multiple. I'll look at what percentage of the time a 5R multiple gets hit, a 4R multiple, a 3R multiple, a 2R multiple, and a 1R multiple. And then what I'll do is I'll say, okay, well, you know what? A 5R multiple gets hit 60% of the time. Full TP, I'm getting 60% of the time at a 5R multiple. 65% of the time, I'm getting a 4R multiple. 68% of the time, I'm getting a 3R multiple. 70% of the time, I'm getting a 2R multiple. And then 80% of the time, I'm getting a 1R multiple. So then that way, I know when I enter my trade, it's like, okay, well, you know what? Like, every single winning trade that I've taken, 65% of them have hit a 4R multiple. So I want to try and hold at least to a 4R multiple. And if we can get into that 4R multiple range, then I'll throw my stops to a 3R multiple. Different things along those lines is what helps me make money and then keep my money, more importantly. And then what also you can actually look at too, by having a really direct and in-depth journal that's no bullshit, you're just looking at numbers, you're just looking at your statistics, is you could see, okay, well, you know what? My average 5R multiple for a full TP hits about, let's call it, again, 65% of the time. From that, how many of these trades actually continue to run past TP, and then how many of these trades pull all the way back to break even, and then how many of these trades pull back and then continue to run past my full TP. And you should be able to see and dissect, okay, well, you know what? 25% of the trades out of the 5R multiple that was hit pull back 10 points in the direction against my position. So price pulls back 10 points, and then we continue to run another 15, 25 points where I can squeeze out maybe an extra 2R multiple. So in the situations where you do hit full TP, you're like, damn, I think this trade can continue to run. Again, only 25% of the time, price pulls back 10 points and then continues to run to full TP. 75% of the other time, it just comes back and stops me out completely at break even. So you know what I'm gonna do? I'm gonna throw my stop loss up to where the pullback isn't only 10 points, but I'm allowing price to pull back a max of 12 points in that situation, because I know, again, 25% of the time it's going to pull back 10 points before continuing. And at that point, you know, if we start pushing past 10 points, we start getting to 11, 12, 13 points, I want to cut the position, because 75% of the time it'll come back to me and stop me out at break even. But a lot of you guys aren't going to know these types of metrics and these types of statistics with your edge if you're not tracking your trades. That is what's so important here. And you know, there's a lot of like brain rot that you'll see on social media, guys. I'm not gonna lie. Like, people are talking about like, oh yeah, you know, it's the weekend, let's go touch grass, let's fucking get grass in between our toes. And you'll be scrolling through TikTok and I'll be hearing this, and it's like, this is actually pretty wild, because I remember when I first started, and again, granted, like, everybody's gonna be in different phases in their trading career. I'm not saying, you know, you gotta be on the charts every single day. No, what I'm saying is, especially in the beginning, you want to get in as much screen time as you possibly can, because that's what's going to separate you from the people that take kind of trading as like a joke, as a hobby, or they see it as kind of like, you know what, like, I just want to come onto the markets and execute positions. Like, those people realistically will never make money long term, and you have to be determined and be willing to actually put in that extra amount of work that the majority of people are not doing, so you can separate yourself from the majority of people who are not profitable, to really start making money in the long run. And then once you actually start putting in this type of work, not only will that bring up your level of confidence inside of the markets when you're executing trades, but what that'll also do is allow you to size into your positions heavier. Now for me, I'm somebody who I like to experience like more explosive growth inside of the markets. And once I start seeing a little bit of profit inside of my account, I look at profit as, okay, well, I just bought myself more trades, so I'm allowed to risk more and try and just protect my initial balance as much as I can. And that's what's really allowed me to see those huge six-figure days inside of the markets, that you guys can go back on this YouTube channel and literally just scroll through my channel and say, oh wow, 50K trade breakdown, 100K trade breakdown, 80K trade breakdown, 75K trade breakdown. Like that's what allowed me to do that. And again, I'm here to let you guys know, like, this is the type of work that you need to put in if you're serious about making money long-term inside of the market. Just like all of my other students who have made money, like that's $300,000 in just profit and payouts, like that doesn't come easy. He puts in the work and he reviews his own mistakes and seeks for improvement. And those are really like the differences that I've seen for, especially from my students who make multiple six figures a year to only a couple $1,000 to only a couple $100. Like that's the difference, putting experience aside. So anyways, boys, I'll talk to you guys in the next video.